Character and Holding Period of Distributed Assets by Brian Julius. Operating or current distributions. Current distribution is when a distribution that does not completely terminate the partner interest in the partnership. Generally, a current distribution of either cash or property is a non taxable transaction to both the recipient partner and the partnership. Partnership reduces the recipient's partner's capital account and recognizes no taxable gain or loss, only a book loss. The recipient partner generally reduces their outside basis by the basis of property receives, taking a carryover basis in the distributed property, and will recognize no gain or loss. The limitation is if the partnership receives cash distribution in excess of the tax basis, the partner will recognize the taxable capital gain to the extent of the excess. Uh, Mid-year advances and partner draws against the partner shares of income. It's a distribution of money or property during the taxable year. It's treated as a distribution made on the last day of the partnership's taxable year. Deemed money distributable caused by a reduction in a partner's share of partnership liabilities also receive draw treatment. The partnership takes the property off its books and reduces their partner's capital accounts by the fair market value of the distribution. A book gain or loss will be recognized. No restriction on the amount by which the partner's capital balance can be reduced. Unlike tax basis, the partnership can reduce partner capital to negative. Now, liquidating distributions completely terminates the partner's interest in the partnership capital and profits. It's a non taxable transaction to both the partner and partnership. The partner takes a tax basis in the distributed property equal to the partner's outside basis pre-distribution. If the receipt of cash exceeds the partner's outside basis, the partner must recognize gain in the amount of the excess. In an all cash liquidating distribution, if cash received is less than partner's tax basis, then the partner recognizes loss. In an all cash or ordinary income assets liquidating distribution, if cash plus tax basis of the ordinary income assets were received is less than the partner's outside basis, the partner recognizes a loss. A partnership interest is a capital asset, and any gain or loss on its sale will be a capital gain or loss. Gain or loss is the amount realized for the transfer of the partner's partnership interest, less the adjusted basis in the partnership interest. Gain or loss applicable to the share of net appreciation or depreciation in the partnership's ordinary income assets. It's generally taxed as ordinary income or loss. The remainder would be a capital gain or loss. The amount realized in the sale of a partnership that is attributable to unrealized receivables or inventory is treated as ordinary income. And the rights to receive these payments for goods and services uh, can be done through depreciation recapture, excess depreciation, mining exploration expenses recapture, stock in a DISC C13 or foreign corporation, franchises, trademarks, oil, gas, geothermal property, excess farm loss recapture, market discount bonds, and short-term obligations. All these can be uh, all these can be utilized to lessen taxes. And there are three categories of inventory. The first category is true inventory and dealer property held primarily for sale to customers in the ordinary course of the partnership's business. And the second category is property other than capital assets when sold or exchanged by the partnership, such as accounts receivable of cash basis taxpayer, realized AR accounts receivable of accrual based taxpayer, and depreciation recapture and all unrealized receivables. The character of the gain or loss is going to be unrealized receivables are ordinary income. Depreciation recapture is ordinary income. Inventory is ordinary income for the first 5 years. Then it will change depending on how it's utilized by the partnership. And other property depends on the partnership's use of property or reason of holding it. If if it is being used by the partnership in some way or another. And for both operating and liquidating distribution, the character of distributed assets in the hands of the partner may stay the same as it was in the partnership to reduce the opportunity for converting ordinary income into capital gain. If a partnership distributes a capital asset that would be characterized as inventory in the hand of the terminating partner, partner will have ordinary income for a sale, not a capital gain or loss. Taking a liquidating distribution to avoid recognizing a gain. This option offers less cash than a sale usually, but it avoids a distribution and the tax with it for the year.